Gold just passed $2,000 an ounce, setting the stage for a historic new bull run. Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. So find out why and get instant access to his #1 gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using the same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. So to get a copy of his new free report with all the details, simply go to 2022goldmania.com. Again, that's 2022goldmania.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to Stansberry Research, catching up with Rick Rule today, founder of Rule Investment Media. Rick, always good to welcome you back on the show. Good to see you.
Daniela, my pleasure. Thank you for having me back on.
Yeah, well, we were saying offline, no shortage of news here. Few items that if I had to choose, I want to address with you. Obviously, we're gonna tackle inflation. Want to get your thoughts on if you think a recession is imminent, given that yield curve that everyone's talking about. But first, there was an article that someone sent to me over the weekend, a mutual friend of ours, actually, Rick, and I thought this would make an interesting talking point here. And it has to do with the likelihood of a return to the gold standard. Are we on the edge of a new gold standard? And it is an article penned by Alistair MacLeod, where he writes that the Russians and Chinese will be acutely aware that Western currencies, particularly the yen and euro, are likely to be undermined by recent developments. The financial war, which has always been in the background, is emerging into plain sight and becoming a battlefield between fiat currencies, and it's full on. The winner by default is almost certainly gold, the only reliable reserve asset for those not aligned with Russia's unfriendliness. And he says it's still a long way from backing any currency, but the default winner would be gold. I want to get your thoughts. Is this a direction you think we're headed in? Does that make sense to you?
Well, it's a subtle question. I do think that a default winner is gold. It is one of the only, if not the only, financial asset that is both a medium of exchange, which is to say a money, but also an asset in and of itself, rather than being a promise to pay. The renminbi, the dollar, the ruble are all really, in the end, promises to pay. But gold is in effect payment in and of itself. So I do believe that gold's prominence as a medium of exchange will increase as a consequence of unstable geopolitics, and increase too inadvertently because of the U.S. government's decision to weaponize the U.S. dollar and weaponize the SWIFT system. We've used the dollar's preeminence around the world. I say we advisedly. You and I both carry American passports. Our government has decided to weaponize our currency and our payments mechanism, taking advantage of the fact that the world is on a dollar standard to attempt to enforce American policy extraterritorially. Whether or not you agree with the direction of U.S. policy, I think there is no doubt that there are a lot of countries and a lot of people around the world that don't appreciate the extraterritorial nature of U.S. policy, and thus don't trust the U.S. government and the U.S. government's proxy, which is to say the U.S. dollar. The consequence of that is that I think gold will play an increasingly important role, or perhaps you should say resume an increasingly important role in global trade. I don't believe that that leads any country to a gold standard. Those are very different circumstances. People become politicians because of a lust for power and a belief that their own policy alternatives are better than other people's policy alternatives. A gold standard is always a limit to a political system's power and a politician's power. So if you are a politician, the idea that your fiscal policy should be held hostage to gold, or that your ability to issue specious currency should be held hostage to gold, is to you a circumstance to be avoided at all cost. The idea, as an example, that Mr. Putin, were he on a gold standard, would be unable to affect fiscal policy in rubles, but rather would be tied to the flow of gold. Or the idea, for that matter, that Mr. Xi or Mr. Biden would voluntarily allow themselves to be constrained in that fashion by the, quote, barbarous relic, seems highly unlikely to me. So I think that, I mean, I don't see any reason why you and I couldn't be on our own gold standard and measure our purchases and sales in gold and do transactions between ourselves in gold. I think that the distributed ledger technology, the blockchain technology, is coming along very quickly, which will allow the tokenization of gold and the utilization of gold in small transactions and large. And I think that large transactions, as an example, by and between, say, Russia and India, or China and Indonesia, will become increasingly denominated in gold. But I don't think that you will see any fiat currency in the world tied to a gold standard simply because it limits the power of the political class.
Could you see a new reserve currency, digital in form, backed by gold?
I could see gold as part of a basket of assets, but the purpose of gold is sound money, and the concept of sound money and the concept of a powerful state are in direct opposition to each other. Reserve currencies that are made up of a basket of fiat currencies, so that a supranational organization like the World Bank or the United Nations could do the same type of fiscal policy and frankly the same type of counterfeiting that exists on an individual ad hoc basis today, might find real favor with the political class. It would give them another level of obfuscation, another way to divorce their power from what is good for you as an individual. So it wouldn't surprise me to see special drawing rights or some other basket of fiat currencies formed. But to the extent that you anchor that with gold, to the extent that you make it more stable, you remove policy options from policymakers and politicians. And that is as popular with them as AIDS.
Okay, two paths I want to go down. You brought up two very important points. Okay, first, let's touch a little more on the weaponization of the US dollar and the repercussions. How does this play out? Does that dethrone the US dollar down the road?
I definitely think it weakens the US dollar. There are large groups of people in the world, or at least leaders of large groups of people in the world, who don't believe that the US has the right to meddle in their internal affairs. Those might include Iran, they might include Saudi Arabia, they might include the Russians, they might include the Chinese, they might include the Indians. There are a broad group of people around the world, or at least leaders of broad groups of people, who believe that the United States is at best inconvenient with regards to their policy goals. And the US forcing of countries that disagree with the projection of US power to adhere to the US line or be kicked out of the SWIFT banking system, the payment system, is at once an extremely powerful tool for the United States and an obstacle to be avoided for other people. The idea, too, that the US dollar is the world's reserve currency almost assumes neutrality. The idea, as an example, that if Japan buys oil from Saudi Arabia, they have to do it in US dollars. And to the extent that the Japanese engaged in some policy alternative that they decided was in their own interest, and the US could then apply sanctions, eliminating the ability for them to trade and settle in dollars, which would obviate their ability, as an example, to buy oil, except at some extraordinary premium. I can understand how countries around the world would view the projection of US power through the currency as being an unnecessary and frankly unacceptable overreach.
if it were to weaken, and if that is the consequences, and what you've just said plays out, why make that move? Why make that move? Because they care? Because does the government really care about the greater good of the world? Is there something more at play? They didn't think about it? Why?
Your viewers are going to hate this. I don't believe that, given the fact that the U.S. defense budget is larger than the next 10 largest nations in the world combined, that they care too much about humankind and care much more about the projection of U.S. power. They may believe they're right, they may believe they're wrong, but they aren't particularly interested in the inputs of other parties. I believe, too, that the United States government, and perhaps by extension the United States voters, have a basic lack of knowledge of economics and don't care too much about economics. I believe that policy goals are more important to the power structure in the U.S. and the power structure in other countries than the laws of basic economics. Think, for example, Daniela, about a topic I'm sure we'll discuss later in this interview: negative real interest rates. The policy by which you penalize savers, you penalize investors on behalf of spenders. The promulgation of negative real interest rates indicates two things: a very, very, very short-term outlook, and a lack of understanding of the basic fairness of economics. The idea that a young person like you, who saves, who generates more utility than she consumes, lending that surplus to me so that I can consume today, and receiving payment later that has less purchasing power than the purchasing power that she sacrificed by making the loan today, is not a force of nature. It's a construct. It's a government construct. And I would suggest to you that the same policymakers who believe in negative real interest rates believe in the weaponization of the currency. I believe that they either have a lack of knowledge of basic economics, or more probably, that their near-term policy goals for them are much more important than maintaining a fair economy for you and I, and for Russians, and for Chinese, and for Indians.
Really well thought out and point made, Rick. The other path I want to go on before we move on to the next topic, just some thoughts on Russia gold. Given the current sanctions, where, to whom would they now hoard all the gold they're mining, keep exporting it to China, the Middle East? What happens to that gold? And do you think we'll see Russia's central bank liquidate some of their gold?
I suspect if the war continues, and if sanctions continue, that the Russians will have to liquidate some of the gold. I don't think, despite their best efforts to the contrary, that they will be able to effect very many transactions in rubles, simply because, as much as the world distrusts the United States, they distrust the Russians more. Why, if you could have a first-rate fiat currency, in other words, why, if you could have a high-quality counterfeit bill like the US dollar, would you accept a low-quality counterfeit currency like the ruble? So to the extent that the Russians can't sell other assets in currencies that are fungible to maintain both their war effort and also their domestic economy, I suspect that one of the few assets that they can transact in will be gold. And the consequence of that, I think, is that there's a high probability that the longer the war goes on, the more incentive that the Russians have. Incentive is the wrong word. The more need that the Russians have to liquidate gold. And remember, gold is very, very, very fungible, much more fungible than oil. Once gold has made its way from, say, Moscow to Dubai, the provenance, the origin of that gold is very difficult to determine. So I believe that in addition to the fact that they have to sell the gold, they will be able to sell the gold, albeit probably at a discount to world market, setting up a wonderful arbitrage for the people who facilitate those trades.
So would it not make a dent in the price then?
I think it could. I'm operating myself under the assumption that the supply of gold, the float of gold relative to the stock of gold, will increase in the next 3 to 6 months. Frankly, personally, I look forward to that. I would like to continue to increase my own personal gold holdings.
Okay, so you're
And if you're bullish about gold, you would rather see the price lower than higher.
okay. So you're saying if it were to move the needle, the price would take a hit, but that'd be an opportunity to go in and buy.
For me, understand when we talk about gold standard, I'm interested in my own gold standard.
Right.
Not, I'm much less interested in the probability that governments might somehow suborn themselves to
I
gold.
mean, I know it's early to think, but like, would we see like a $100 correction of a greater move? How much of a dent?
You know, Danielle, I've been trying to answer questions like that for 40 years, and my near-term gold price forecasting track record is unblemished by success. I don't know.
Let's talk about inflation back home. Since we last spoke, keeps ticking higher and higher here. Where are we at? How does Rick Rule see the inflationary dilemma right now? Will the Fed be able to fend it off successfully since they've now announced, hey, rate hikes are coming faster than you think?
I think right now that the economy is strong enough that they can pull off rate hikes. I certainly hope that they do. I think that they're going to get a hand because I think that the rapid increases in energy prices and food prices will begin to moderate. In other words, I think that some of the extraneous factors that have caused consumer prices to increase rapidly will abate. But I think that's a false calm. Inflation is all about quantitative easing, which is to say counterfeiting. It's all about negative real interest rates. The level of interest rate, as we learned in the 1970s, is less important than the real interest rate, which is to say the interest rate on the 10-year Treasury minus the increase in the consumer price index. And I don't see the United States government having the willingness to deal with the underlying causes of inflation, which is to say we're consuming more than we're producing. We're subsidizing that with counterfeiting, they would call it quantitative easing, and with negative real interest rates. We're also causing it to occur with debt and deficits. We're forward shifting the liability for our high apparent standard of living by assigning the bills to our children, grandchildren, and great-grandchildren. There seems to be a fondness among voters to inflict poverty on subsequent generations rather than alter their own living standards. And that's extremely popular. So I think that the underlying cause of inflation isn't so much to do with, as an example, the increase in energy or food costs as a consequence of the war. But I think there are much stronger underlying causes of inflation, including primarily quantitative easing, debt and deficits, and the most pernicious of all, negative real interest rates.
Well said. And for the folks at home wondering, well, why is Rick Rule calling QE counterfeiting? Because it's creating.
Specious currency. It is precisely counterfeiting. Daniela, I read the other day that between 35 and 40% of all the US dollars in circulation have been created in the last 30 months.
Wow.
Now,
Yeah.
was that done to accommodate an economy that's now 30 or 40% larger? Of course not. It has nothing to do with
Yeah.
stock to float. It has everything to do with the fact that we voted ourselves a bunch of benefits and neglected to pay for them. And the only way that we could pay for them was to create specious currency units. Specious currency units, if you did it, are counterfeiting, unless, of course, you were Senator Camboni, in which case it would be policy and you would be highly popular.
I like the ring of that, by the way. But
I do too. I do too.
okay. Let's talk about the yield curve and the risk of a recession. The market's most closely watched part of the curve inverted, and if its record over the last half century is any indicator, the U.S. could be headed to a recession soon. Some experts even saying by the end of 2023. Your thoughts on a recession?
Uh, that is a crazy-making statistic. The idea that there isn't sufficient demand for credit in the longer term means that businesses lack the confidence to invest. That's what it means. And business intention, commercial intention, is often a very good indicator of recessions. I need to disclaim something, Daniela, that will give your listeners a chuckle. I have absolutely corrected 17 of the last 3 declines. I'm always nervous. I'm always nervous. And so my track record with regards to predicting recessions and things like that is not particularly accurate. I believe that the economy that we're existing in today is buoyant partly as a function of artificially low interest rates, partly as a function of the fact that savers and voters seem not to care too much about quantitative easing or about debt and deficits. If you had a lender strike, which is to say the U.S. Treasury gave a Treasury auction and nobody showed up, and the Treasury had to buy the whole issue, then I think that you would have the same crisis in confidence that existed in 2008. And I think a recession is a logical outcome. I believe myself that the broad precepts of Austrian economics are correct, which is to say that you have credit-driven expansions and then you have confidence-driven contractions. It would seem that the political class, to the delight of the voters, has decided that we don't have to have recessions anymore. I don't happen to believe that's true. I think that there is a cleansing effect from a recession. Not that I want to inflict one on myself, but I suspect that irrespective of my own wants, that one will occur of its own volition. As an example, Daniela, let's do a little bit of arithmetic around the interest rate rise. If you look back over 4 decades, the U.S. 10-year Treasury has been the standard by which all other securities are priced and judged. It's the most liquid savings and investment product in the world. And traditionally, the U.S. 10-year Treasury, by traditionally I mean going back 40 and 50 years, traditionally the U.S. 10-year Treasury has had a positive yield over the CPI stated rate of inflation. Your government, the U.S. government, suggests that the current inflation rate is somewhere between 6.5% and 7.5%, depending on which agency you ask. And the U.S. 10-year Treasury is yielding about let's call it 2, just to make the math simple. What that means is that if the pricing of the U.S. 10-year Treasury were to return to mean and have a positive yield, it would have to yield about 7. Now, think of the impact on federal, state, and local budgets if the interest charge tripled or quadrupled. And if you really want to get scared, the U.S. 30-year fixed mortgage, the instrument that most people use to buy their principal residence, their biggest personal expense, has traditionally traded at a premium to the U.S. 10-year Treasury. So if the CPI stated rate of inflation was 6.5, and hence the Treasury was 7, the 30-year fixed mortgage rate, if it reverted to mean, would have to be 7.5%. Imagine what would happen to affordability and hence housing prices if the 30-year fixed mortgage was to revert to the 4-decade mean. Imagine what a 7.5% first mortgage rate would do to the economy. If we go to a path where the economy is sustainable, which is to say that savers, get a real rate of return, and spenders are forced to bear the real cost of capital, I suspect that we would endure a substantial and unpretty recession, very much like the recession that we faced in 81 and 82, when Mr. Volcker rebalanced the economy. Now, rebalancing the economy set up a tremendous 20-year boom, but it happened at the cost of 3 ugly years in the economy.
What is the likelihood of that happening?
You keep asking me
Very high?
questions I'm ill-suited to answer. I don't know. I don't know ultimately how far you can push on a string before it refuses to push. The circumstance that we're in right now, Daniela, seems to me to evolve around confidence much more than economics. Although it isn't true, I love to say that the root word of confidence is con. And the longer that savers put up with this foolishness, which is to say, the longer that savers are willing to accept a 2% yield in a currency that's depreciating by 6.5% a year, the longer that the current set of circumstance can continue. I personally am orienting my own savings and my own investment portfolio to reflect a very real fear of a crisis in confidence and a very real fear of a recession. I am not one of those persons who buys the latest fad asset. I'm not one of those who buys a tech startup at 100 times revenue, or buys a SPAC, or buys an unpronounceable cryptocurrency out of fear of missing out. I'm a very different type of investor right now, a much more cautious, much more conservative investor who doesn't count on continued liquidity.
Well, okay, on that point, I was going to ask you, let me rephrase that question, say, you're a thinker, you prepare for crisis, you are not one to sit back. So how does Rick Rule prepare? And I also know you love stuff that's on sale and a good deal. So I guess my first question is, would you scoop up some tech stocks right now?
I don't think that the tech stocks have fallen far enough for an investor like myself who doesn't have a deep grounding in technology. If I understood more about technology, if I had better personal competitive advantages over other investors, I might be extremely interested in the technology stocks. I don't like to buy an asset class that I don't personally know how to value. And trying to do net present value or risk-adjusted net present value in a technology I don't understand and a market I don't understand is not the kind of thing that I can do. I believe right now, as an example, despite the fact that we'll see rising interest rates, that smaller community bank stocks are hated. They're really, really, really under-owned, and they're very good businesses. Such good businesses that, despite the fact that I'm retired in '69, I'm starting a new bank. So I'm attracted to that. I'm very, very, very attracted to specialty insurance companies, which I think are also very, very cheap. And I think that the government's ability to insure us against all contingencies will continue to wane, which means that people will require specialty insurance. The fact that something will be required and that it's cheap is attractive to me. I also continue to believe that gold, in a historical circumstance, and perhaps for speculators, silver, are cheap. I believe that they offer up, they being gold and silver, offer up the ultimate insurance, which is insurance against collective stupidity. And I feel a very strong need personally to be insured against collective stupidity. We've talked before, too, about the fact that I have been maintaining a lot of liquidity, despite the fact that my US dollar liquidity is costing me purchasing power on a quarterly basis. I believe that having cash or cash substitutes is something that you have to do, despite the fact that it costs you. Because if we do have a crisis in confidence, it would be very easy to see a replay of the 2008 circumstance. And if you had liquidity in a market that was illiquid, you would have the ability to take advantage of the circumstance, as opposed to being taken advantage of by it. I realize these are very boring discussions. I think, too, if you have a 3 or 4 year outlook, that oil stocks are cheap. I believe that the oil price falls from here, but I also believe on a net present value basis that the oil companies, the domestic oil companies, are discounting $70 oil and probably $2.50 gas, while in reality the commodity prices are much, much, much higher. The share prices might fall in the near term if the oil quote falls in the near term, which I think it might. But if you have a 3 or 4 year outlook, I think those are cheap. But the cheapest asset class of all, and this is going to get me a lot of hate, Daniela, but that's okay. The cheapest asset class of all in the equities are Russian stocks. Russian stocks were already the cheapest resource stocks in the world by a 50% margin, and then they fell by 80%. If you can answer the moral question, in other words, if you decide that you can own some aspects of the Russian economy, given the politics of Russia, given Russian aggression, and you are willing to take the risk that those companies won't be able to pay you dividends in US dollars for some substantial period of time, that you may or may not be able to trade them on Western exchanges for substantial periods of time, the Russian resource stocks, the Gazproms, the Lukoils, the Polymetals, the Polyrusses, the Norilsks, Fosagro, those stocks are felony cheap.
But I was also going to say, if you're willing to wait a very long time. I mean, we know that the repercussions of the sanctions. I mean, how many
Yes.
years?
Well, it's interesting, Daniela. You and I have had this discussion before. Now that I'm 69 years of age and I have less time on Earth, I've become more patient. I have lived through many 5-year periods in my life, and I don't consider 5 or 6 years too long to wait for a 10-bagger. It's interesting that most people in the world seem to have trauma holding investments over a long weekend. I suspect that's because they haven't done enough research into their basic investments that they have a sense of the value of what they own. I think a lot of people are addicted to price quotes in the absence of having an opinion around value. For myself, the idea, leaving the morality of it aside, and I don't suggest that people leave morality aside, leaving the morality of investing in Russia aside, the idea that you could buy Gazprom, which by reserves is probably the second largest oil company in the world after Aramco, and you could buy it at 1.5 times cash flow, suggests to me that a speculator who was willing to use money that he or she could lose could reasonably expect over 5 or 6 years a tenfold return in a company that's paying a 7 or 8% current yield and is the largest and finest company in the world. We're not talking here about a Vancouver penny dreadful. We are talking about companies that are the largest and lowest cost producers of various commodities in the world.
Point made.
So when you ask me what's cheap, Russian stocks are stupidly cheap, sometimes for good reason.
Point made. I want to wrap with this comment from JP Morgan CEO Jamie Dimon, which made me think of you when I read it. He's identified 3 forces that are likely to shape the world over the next several decades. A U.S. economy rebounding from the COVID pandemic, high inflation that will usher in an era of rising rates, and Russia's invasion of Ukraine, which will result in a humanitarian crisis. Do you agree with that summary? Is there a point you'd add? Or
Yeah, I do, but he missed the biggest one. He missed the single biggest one, which is human inclusion. The fact that you and I are having this discussion today wouldn't have occurred 30 years ago because popular media and, in fact, popular culture wouldn't have allowed a responsible female journalist. They wouldn't have allowed her the gravitas to do what you're doing. So, at least in the United States, but in much of the Western world, well, there's a long way to go. And by the way, you know I'm no bleeding heart ESG You know what I'm trying to say? I mean, nobody could ever confuse me with being politically correct. But the idea that for most of history we ignored the intellectual contributions of half of humankind was really, really, really stupid. And the benefit that we have received in the last 30 years and will receive for the next couple hundred years as a consequence of including women in the discussion is really understated. The other thing that's happened is perhaps as a consequence of educational standards, or perhaps because of communications technologies, the idea too that the ability to contribute and the responsibility to contribute is no longer just white people. One of the things that's really saved us, Daniela, has been technology. And the fact that 5 or 6 pimply-faced kids could take over a garage in Sunnyvale, California, and out would pop Apple or out would pop Google. Yeah. I think that an overlooked facet of the last 40 years has been that our individual creativity and tenacity has been so spectacular that it's financed our collective stupidity. And I think that's important. And what I think is even more important going forward is that garage, which hitherto has always been in Sunnyvale or Cupertino or Silicon Valley, will be in Lagos, or it'll be in Jakarta, or it'll be in Kinshasa, or it'll be in Guangzhou. I think that the inclusion of women and the inclusion of folks who don't look like me will be the biggest unsung boom in the next 50 years. If you look back over 30 years, as you know, Daniela, I've traveled to a lot of frontier market countries, being dragged around looking at mines and oil fields. And one of the things that we as a species have done that has been spectacularly successful is we have increased the living standards of the bottom half of humankind markedly over the last 30 years. And that continues. And I think what Mr. Diamond probably neglected on the bull side are all the white swans that will come from the inclusion of well more than half of humanity in the ability and, in fact, the requirement to contribute.
Brilliant. Rick Rule, I always appreciate your insights, and I know you have a final thought for investors. Your offer still stands.
As always, Daniela, I love talking about natural resources, and I love in particular talking to your listeners about natural resources. And so, believing in incentives, here's the incentive. Any of your listeners who want to know what I care not so much about resources, but their own resources, should feel free to go to a website, ruleinvestmentmedia.com. Enter your natural resource stocks, and I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment individually on offers where I think that my comments might have value.
There you go, Rick Rule. Always appreciate your time, your insights, and we will see you soon.
I'm looking forward to that. Your European subscribers should plan on coming to see us in Zurich in early June.
I was gonna say, is it too early to talk about that? But because you'll probably be on before that. But you should start preparing, because if you are in Zurich or plan to be in Zurich, June 1st and 2nd, Rick and I will be there, and we'll all be moderating an all-star panel with Rick and Frank Holmes, and I can't wait for that. So thank you.
Thank you.
All right, and if you want more information, check out the Swiss Mining Institute. That's where we will be, SMI. Thank you all for watching. We'll have much more coming your way on Stansberry Research, so be sure to stay tuned. And don't forget to be alerted of the latest interviews coming your way. To sign up at danielacambone.com. You won't want to miss a beat. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.